Behavioral finance. Why do smart people make bad financial decisions? Why do investors sell at the bottom, chase performance, or hold on to losing stocks for too long? The answer isn't always about math, it's about mindset. Today, we're diving into the world of behavioral finance, how your brain, emotions, and biases can quietly sabotage your investment success. Welcome to the channel. My name is Eric Silvaggi. I'm a wealth advisor with Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, make sure to subscribe and click the like button. Let's explore how behavioral finance works and what you can do to protect yourself from your own instincts. What is behavioral finance? Behavioral finance sits at the intersection of psychology and investing. It studies how emotions, cognitive biases, and social influences affect our financial decisions. Traditional finance assumes investors are rational. Behavioral finance knows better. It explains why people chase trends, panic during market downturns, and make decisions that feel right but cost them in the long run. The DALBAR Study, the cost of bad behavior. Let's look at the numbers. According to DALBAR's 2022 quantitative analysis of investor behavior, the average U.S. investor earned just 4.8% annually over the past 30 years. Meanwhile, a balanced portfolio of 65% equities and 35% fixed income returned 8.8%. That's a 4% gap every year for 3 decades. And with compounding, that difference could mean significant loss of growth. Why? Because of poor investor behavior, market timing, chasing returns, panic selling, and emotional decision making. As a wealth advisor, these are the most common biases I see. Over the years, I've seen firsthand how behavioral biases show up in client conversations, especially during volatile markets. Here are the most common ones I see and how they impact decision making. Confirmation bias. Confirmation bias is the tendency to seek out information that supports what we already believe and ignore anything that contradicts it. How it works? We search for news or data that confirms our opinion. We interpret neutral information in a way that supports our views. We avoid sources that challenge our thinking. For example, an investor who believes a stock is a great buy might only read positive news, ignore negative earnings reports, and follow analysts who are bullish, while dismissing any bearish opinions. Loss aversion. Loss aversion is the idea that losses hurt more than gains feel good. In fact, the pain of losing $100 is about twice as powerful as the joy of gaining $100. How it shows up? Holding on to losing investments too long, hoping they'll rebound. Selling winners too early to lock in gains. Avoiding risk, even when the reward outweighs it. For example, given the choice between a guaranteed $500 gain or a 50-50 chance to win $1,000 or nothing, most people take the sure thing. But when faced with a guaranteed $500 loss versus a 50-50 chance to lose $1,000 or nothing, people often gamble to avoid the loss. That's loss aversion in action. Overconfidence bias. Overconfidence bias is when we overestimate our abilities, knowledge, or control over outcomes. How it works? We believe we're better at picking stocks or timing the market than we really are. We're too certain about our predictions. We underestimate the risk and overestimate our control. For example, an overconfident investor might trade too frequently, ignore expert advice, or under-diversify, believing their picks are superior. This often leads to poor performance and higher costs. Recency bias. Recency bias is when we give too much weight to recent events and assume they'll continue. How it shows up? Believing a stock that's gone up recently will keep rising, becoming overly pessimistic after a market crash. Chasing performance by switching into recently strong performing funds. Why it matters? Recency bias can lead to short-sighted decisions, buying high, selling low, missing long-term opportunities. Anchoring bias. Anchoring bias happens when we fixate on the first piece of information we receive, like a stock's purchase price, and base future decisions around it. How it works? We anchor to a number, even if it's irrelevant. We fail to adjust our expectations when new information becomes available. For example, if you bought a stock at $100 and it drops to $70, you might hold on to it, waiting for it to return to $100, even if the company's fundamentals have changed. Herding mentality bias. Herding bias is when we follow the crowd, buying or selling simply because others are doing it. Why it happens? FOMO, fear of missing out. Belief that the crowds know something that you don't. Comfort in numbers. For example, buying into a hot trend during a bubble, panic selling during a market crash, jumping into a stock because everyone else is. The result? Irrational decisions, market volatility, and often buying high and selling low. Home bias. Home bias is the tendency to invest mostly in domestic markets, even when global diversification could offer better returns. Why it happens? Familiarity with local companies and regulations, avoiding currency risk or foreign tax issues, patriotism or loyalty to the home economy. For example, Canadian investors are notorious for home bias. Despite Canada representing only about 3% of global equity markets, Canadians often allocate over 50% of their equity portfolios to Canadian stocks. Key issues: sector concentration. The Canadian market is heavily weighted towards financials, energy, and natural resources, which limits exposure to high growth sectors like technology and healthcare. Reduced diversification. Overexposure to domestic markets increases vulnerability to local economic downturns, policy changes, or geopolitical risk. Actions you can take to mitigate your own biases. Here's how to protect yourself from your own instincts. Take a long-term view. Don't let short-term noise derail your plan. Focus on goal-based planning. Align your investments with your life goals. Stick to a disciplined strategy. Avoid emotional reactions. Diversify globally. Don't let home bias limit your growth. Stay calm during market turbulence. Look at past corrections for perspective. Avoid news binging. Financial media thrives on fear and volatility. And most importantly, working with an advisor who can help you stay grounded when emotions run high.